Hello and welcome once again to your weekend review and look ahead. I am Will Hassel. Kind of an interesting week this past week in terms of trading and what's going on in the markets. We've heard some stuff out of Ukraine, both good and bad, both that clashes are starting to rise a little bit and that Putin may be trying to go and get this all to stop as well. So interesting news there. Some also interesting things coming out of Europe in a different way. Mainly the European Central Bank President Mario Draghi, he did signal that the bank will probably cut interest rates or take other stimulus measures at the end of June. The euro was kind of we really got smacked around there. Took a hit. It was off pretty much year highs. It was on the year highs going into the meeting, and then it kind of tumbled down. But I'm not too big of a macro guy, so I'm gonna stick to stocks, which I know best. A lot of other interesting news happened. I will be covering the Apple Beats potential deal. Let's not forget that this is still a potential deal, everyone. They can not sign it. They could sign it. Who knows? I always like to highlight that. I saw in the Wall Street Journal today, in Business and Finance section, I saw 2 stories about the Beats and Apple deal. People are acting like it's already happened. It still may not happen. In fact, I'm betting that it probably won't happen. But I'll get to that later. We also had a testimony from Miss Janet Yellen at the congressional hearing today, and that was on Wednesday. Wednesday and Thursday were very, very, very interesting days, I would have to say. Friday as well. Looking at our standard spider chart of the Dow, the DIA ETF, we look at let's look at some volume here as well. And we see Thursday we did close all-time high. We hit an all-time high on the Dow, and then I believe we closed at an all-time high on Friday. Friday was an all-time closing high. Thursday was like an all-time high, meaning it just didn't close there. And what do we see from volume? Volume is a big thing that's really starting to concern a lot of people. We saw the biggest volume on Tuesday, and that was selling volume. Now this is the ETF, but we can go and kind of track a little bit of how they looked as compared to the actual, market itself. Thursday, the only other kind of big updates were when we went and hit those all-time highs, but still not about almost the same. A little bit more volume there than there in that single move going down, but volume it still isn't really doing a whole lot. It's almost stupid now to even have volume charts because they tell you nothing other than volume is slowly declining. I'm gonna bring highlight to Thursday, Friday. Big swings. P&L swings for a lot of people. Wednesday a little bit too, but Thursday, Friday mainly because you had these kind of, we're kind of start rising first, and then we get slammed down midday. Selling kicks in, close flat, on the close. Friday, have momentum up, slam down, momentum back up a little bit. It's these really kind of intraday swings that are hurting some people's P&Ls. If you're a day trader, you like this activity, but for some of the people that don't day trade, that do less risky trading, some investing, and they check their account every day or are checking their account, saying it, they see this and they go same kind of thing with the SPY. It's also some pretty okay volume down in the upswings, but a lot of volume on the downswings. Major, I forgot one of my key things I always say. And the Dow did close above all of its simple moving averages. The yellow, as we can see here, with our yellow being the 21-day, red being the 50, and blue being the 200. Back to the SPY, still kind of same kind of pattern, except this one ended lower. It didn't make all-time highs. Now remember, when we say all-time highs, they are all-time highs, but it still means that the Dow is just barely positive for the year. We have had a lot of volatility, so when we reach these new all-time highs, that means the Dow is starting to gain traction, starting to be positive for the year. But here on Thursday, you really get to see that PL move a whole lot more there than you did on Friday. The SPY did go and close above its simple moving averages as well. Now, let's look at the NASDAQ, where there was some pain, mainly because of Twitter's absolutely terrible action there, and along with Tesla, which we will also cover, which got hit because of its earnings as well. Closed below all of its simple moving averages. I mean, you talk about whipsawing. Look at the QQQ. I'm also going to show you the IWM. Same kind of charts, the QQQ, but let me just go and bring this up to 3 months and just look at that. It's just been you can go and draw the trend lines and all that, and you just see it's just been getting hammered. Just barely starting to go and get in with that 200-day moving average, but other than that, it's just been getting straight hammered. In fact, let's draw some trend lines. Draw them right here, this candlestick. Better not look at this down trend channel right here, right off that gap as well. Now, I am not a market technician or anything like that. I'll let my friend Ben Banks go and do better drawings than that, but just trying to go and get you guys to see what I'm talking about here. This kind of channel right here. I'll even do the channel. You see that right there. I know it's a lot of lines on there, but I'll start clearing those off. But yeah, you can go and tell what I'm talking about from those drawings. It's just it hasn't been a good year for the Russell so far. So just want to highlight that. Make sure you guys keep that, because what is small caps? Small caps are growth stocks. That's the 3-month chart. I'll go back to the 5-day for the VIX. Kind of getting back down to those 12 levels, the sub 13 levels that we were talking about from last week, where I mentioned 14 being a big, implicated for the VIX as well. But we've been under 14 except for Wednesday when Janet Yellen spoke, but we've primarily been under 14 for the entire weekend. It did close below its simple moving averages, so there's something to say about volatility. Maybe you do start buying a little volatility here down at these cheaper levels, because it has proved to be a pretty good hedge for your portfolio this year, just because of how volatile the markets have been this year. Getting into some of the economic data and events that are going to be going on this week. On Monday, we have no data except for the April Treasury statement. Should show a surplus for the month of about $113 billion. On Tuesday, we have the April National NFIB index, which is a measure of small business sentiment, is released. So that'll be good to go and give a good tale of how the economy is doing in terms of small business. April import prices, we are expecting a rise of spot 4% versus the last period of a rise of spot 6%. April retail sales, which I'm going to be highly paying attention to, we're expecting a rise of spot 4% versus the last period of 1.1%. That was a big retail sales number. And then we also have March business inventories. We're looking for spot 4% versus last period of spot 4%. So not looking for no change there. On Wednesday, we have only one data point, and that is the April final producer price index, or PPI. We're looking for spot 2% versus the last period of spot 5%. On Thursday, we have first off, Janet Yellen will be speaking at the National Small Business Week in Washington, so she is going to be relying off of what we get on Tuesday in terms of the small business index, and you may want to pay attention to that, because as we've seen on when Janet Yellen does go and talk about some of this stuff, she does go and get questions, and when she answers those, the market reacts. So just keep an ear out for that. And a big thing that I'm going to be looking out for, April CPI. If you don't know what that is, that's the Consumer Price Index, aka inflation gauge. We are expecting a rise of spot 3% versus a rise of spot 2% of last period. Should be interesting to go and see. That way we know if inflation is indeed accelerating or not. In my camp, I think it is. That's why I'm long XLU. If you don't know, that's a hedge strategy. Keith McCullough has been talking about that for a while. And I am in the camp that says, maybe growth isn't slowing, but I do see this inflation that we're seeing. You look at the prices of coffee, the CRB food index, and how all those have just been killing it this year. You look at slow growth utilities and treasuries, and to me it just makes a good point that there is inflation out there, and that it probably is rising. And we also have the April industrial production numbers. We're expecting that to rise spot 1% versus the last period of spot 7%. We also have the April capacity utilization. We are looking for a rise of 79 spot 2% versus last period of 79 spot 2%. And then we finally have the Philly Fed that day. We are looking for 14 spot 3 versus last period of 16 spot 6. If you remember right, that 16 spot 6 was a big beat for last time. And then Friday we have April housing starts. Housing. Didn't get too good numbers out of there last time. We are looking for 980,000 versus last period up 946,000. And then we also have the May Michigan sentiment predictions. The first predictions coming out. And we are looking for 84 spot 5 versus last period of 84 spot 1. So there is your look ahead in terms of economic data and things that are happening in the market. I'm going to run through my portfolio real quick. In terms of positions, we'll go through hedge. Like I said, sometimes I keep hedge in mind for 13. It did break 13 quite a while. It is still hovering around 13. I love hedge because it is a hedge. I love being hedged in this market because it often helps out a whole lot. Not a whole lot of movement there though. JP Morgan, kind of been banging around some of these lows, which doesn't make me too happy. I love it down here though. Absolutely love it down here. I would like to buy more. Well, no, I wouldn't like to buy more just because of my cost average. As we can see here, the highs were 61, almost 62, and now it's at 54. So you are getting a pretty good deal, and it does have the best price to tangible book of any of the bank stocks. So I do like JP Morgan. I think it's got one of the best management teams around. Looking at XLU. Now, fellow Leaders Investment Club member Alex, aka the the options guru. His Twitter handle is @InvestmentKid. Alex has been we did have a little bit of a Twitter back and forth about this name. He's got some neutral to slightly bullish straddles on it. He wants it to stay in 41 to 44. Although we did both agree that the trend line was looking really good. Although for Thursday and Friday it did get hit. I'm not exactly sure why. On Wednesday it was looking like an extremely great bet because we did say Yellen go out and say those comments. I mean, I'm down $3.60. I'm not too concerned there because it does have a 3% dividend, and I mean, I do love that dividend. And I think if we see the CPI increase as it is expected, the 30-day yield for the XLU, the SEC, 30-day yield is 3.39. So, that's not too bad. It is only 2.9% off of its 52-week high. Its 52-week high was on March 1st, up 43.52. If I remember right, I think I'm in at 42.98. Yeah, 42.98 is where I'm at. So I can get 2% upside, and I'm not, and I like it. I do like XLU for the rest, really, of the year. I'm not gonna lie. I mean, if we do see these prices in terms of food keep going, and there is this kind of hint of inflation, I think it's a great place to be in. It's also kind of a great hedge to be in, really. Didn't do so well Thursday, Friday, but hey, that's why you have some of those a little bit riskier assets like the high growth stocks to go and bail you out when some of that happens. When these stocks do go down a whole lot. Going into AIG, this has actually been really interesting, I have to say, ever since earnings, where it did get absolutely slaughtered after earnings, and they didn't report earnings I thought were too bad. Here's that 4% earnings drop. I think, if I remember right, they did theirs May 5th. Yes, so May 1st. Yeah, May 5th. They had that big earnings drop, and then it pretty much got back up to these pre-earnings level numbers, and it just kind of perplexed me a little bit. I'm like, what? And I thought maybe almost flight to safety type thing. I'm not entirely sure. It got beat up because of earnings, and here it is, pretty much backed up. It refilled that gap and pretty much got back up to pre-earnings levels. Now, if you did go notice, those were the highs of the week, and it did kind of get a little bit off those highs, but hey, it did report, earnings I wasn't exactly too crazy about, but at the same time, it did go and just beat off all the earnings losses that it entailed. So, I came off that going, that wasn't that bad. Under Armour has been kind of a problem child, I have to say. It's just been banging around this kind of wants to try and get above 50, doesn't want to try and go above 50. It's been in a $4 range. After this, I'll show you my month to date performance, and you'll see what I mean in terms of Under Armour's been kind of a problem child for me. 50 is a big resistance level. And back, remember when I said volume? Look at this, absolutely no volume, all except for when it got added to the S&P, where we had a massive volume right there. Let me go and bring it up to a 1 month chart, 30 days, 20 days. Like I said, 50 looks like it'll be resistance, if not this level over here, which is 52. And then we can start going back into pre-earnings levels in all of that type of stuff. So hopefully we can go and get some more momentum back into Under Armour. They have some good news. I have a feeling that there's going to be good news coming out. I heard some talk about Under Armour. It was up on Friday. A lot of people are kind of like interested. They're kind of looking. They're looking for. A lot of people are actually getting interested because of the levels that it's getting down to, because everyone knows that it'll probably come back up to 50, and they're just kind of interested in where these levels are, right, in terms of where the stock is compared to where it was, and I see it as a discount. So just trying to help you guys get into the minds of what some of the other people are out there. And Starbucks, one of my favorites. Today is the last day of Frappuccino Happy Hour. I will be, of course, going up and getting my Frappuccinos, my venti Frappuccinos, because it is half price. And I had an interesting week. It's been really flat. It's been trying to go down to 69. 70 looks like it's where it's holding. Love the company, as you know. And really hasn't really done a whole lot, I have to say. If we can break above where that 72 is, I think we'd be good. We could get some fresh momentum into the stock, but it's got to get up there. If not, it's just going to be in this trading range of around 71 to 69. So need more news into there to go and really get it back going. Finally, Coors. You won't hear me shut up about it until it finally reports earnings. Excuse me. Not too bad of a pattern actually going into it. And when you look at it at a 3-month term basis, it has actually been improving. It did look like it was going to get up to 90. I think it hit 95, then retraced. But I highlighted it and I said 96 is that key resistance level. When you look at it, it actually followed down on a 3-month chart down to that 21-day moving average. But we look at that 96 line right there, and it's going to have to swing up past 96, and then you can get on the way towards 98 and even 100. And just to go and show you 5-day chart, 3-day chart, now we want a 5-day chart of what I was talking about. It was looking like it could go and hit there, but it didn't. And then it kind of went down. Wednesday went down with the market, swung back, and ended up pretty much on almost near the lows of the week, just a tad under 92. And this one's starting to get a lot of hype as it's starting to get into earnings as well. And moving on into some of the stocks that got a lot of press this week. Let's look at Tesla. Oh, Tesla. Here's that big earnings drop that we saw. People talk about whether it's a tech company, whether it's an auto company. All I know is, actually, as I look at TweetDeck on my desktop, in terms of that inflation that I was talking about, I just see a tweet from Bloomberg News saying ground beef hits a 30-year high. Wow. I'm looking at this chart that Bloomberg just posted, and yeah, wow. Talk about inflation. Boom. Wow, yeah. But Tesla, man, I actually had an argument with my friend yesterday. Well, not an argument, but he's an investor in Tesla. He believes in it long term, and he has a 10 to 20 year period on it, and he doesn't care too much about how it is now. But to me, I was like, his name's Owen. Hopefully, he'll let me at least disclose that much information about him. They beat on earnings, but from what Musk said on the conference call, he even mentioned, I'm looking at the cash flow statements right now, on my other monitor, but I can only get them from 12/31. And by the way, cash flow, you mean cash black hole. Wow, long term. I'm not too big of a fan when it comes to Tesla and their cash. I think they're burning through cash like no one's business. I'm just looking at this cash statement. I'm just kind of a little bit. I mean, this is a company that is struggling to get enough long-term cash for itself, and it is $179 stock. You know, that was one of my points about Tesla to him was, I'm like, okay, they've already done a bond offering to get the Gigafactory, the 1 Gigafactory. You heard Musk on the conference call mention 2 Gigafactories, and there's your rating on Trade Monster. It's an F+. How are the financials? The financials are a D. Let's do more info on that. How about that? How strong is the company's financials? How profitable is the company? Gross margins, 26%. Compared to industry, compared to sector, compared to S&P. Whoa. Debt to equity. Long-term debt to equity. Jesus Christ. Current ratio and quick ratio aren't that bad, but when it comes to, you know, compared to the S&P 500, compared to the industry, their total debt, I'm not too crazy about it. They bleed cash like no one's business. I mean, you could go and make the argument that they've got to go and, you know, spend this money because they are, because they're kind of like a technology company and they're making these huge, you know, plans to go and build these gigafactories. But, I mean, you're having a lot of trouble with cash right now when you have this type of an evaluation on you and you have that large of a, you know, share price. To me, that's just a little scary that you need to do bond offerings to go and get this stuff to work because you don't have enough cash, even though, I mean, here, even you can even look at the 1-year stock chart and just say, okay, so in the past from June 13th all the way almost to June 4th, you know, we'll call it 200, you've seen your stock double, and you still don't have that, you still don't have enough cash. It gets kind of scary to me. It gets kind of scary to me that they burn off that amount of cash, but, you know, that's why I'm not a shareholder. And when we talk about cash, let's talk about the opposite. Someone who has a lot of cash, Mr. Apple Computers. Apple. We did see their shares shrink a little bit on Friday off of the talks of the possible Beats Apple deal. Me and yet another one of my friends from the Leaders Investment Club went and had a Daniel Segunda, aka Mr. at Apex Equities. We had a little talk on Twitter as well about this deal as it actually came out. One of the cool things about Twitter and one of the cool things about some of the guys in the Leaders Investment Club is we'll have these discussions on Twitter as the news comes out, and we, you know, we'll go and share our opinions openly and publicly. We're not, you know, going and, you know, I think that's just an awesome part of what we do. But we talked about this deal. I said, you know, why not Bose? You know, I think better sound quality, but I have to say I was wrong when it came to Bose, because in one of the 2 WSJ articles about today, in terms of the premium market, Beats does have 61% of it. Now they did go and point out that Apple is spending $3.2 billion on this acquisition for only about 3% of their total revenue, which to me doesn't really make a whole lot of sense. Now I have heard the talks of, oh, they're going to be using them for wearables or for a music streaming service. Well, then they're already conflicting with, you know, iTunes Radio. Maybe they're trying to get 2 different types of streaming services to try and, you know, doubly combat Spotify and Pandora, which are kicking their butts in terms of streaming. Wearables, I think that's kind of stupid unless they come up with something that is like completely, like it's some big twist on the iWatch, because to my point, Samsung has had the iWatch out now for almost 2 generations of iWatch, and as soon as Apple comes out with them, Samsung likes to churn and burn products a whole lot, so you'll see the next watch come out soon. Although I have to say, I give Tim Cook a lot of credit for actually going out and trying to spend the cash that he has, even though it is a small amount of cash, but actually doing it and trying to go and get some new talent into Apple via even acquisitions. I mean, Apple, ever since they lost Steve Jobs, they haven't been able to have the creative their creative works come out. The way I describe Apple is it's no different from Ralph Lauren or Michael Kors in terms of you have that designer, and in this case the designer died, so they need to try and get new designers in. So maybe that's what Tim Cook's trying to do. It's definitely not a Steve Jobs move, but then again, Tim Cook's a lot better of a CEO than Steve Jobs. I say this all the time. Steve Jobs was a great designer, terrible CEO. And I think, Tim Cook coming out here and saying, you know what, we're going to do acquisitions, I think that's, really, really, really smart. They're just trying to go, and spend money and try and expand the business in a way that he can't otherwise do right now, because he just doesn't have the designers and just doesn't have the products really rolling out. And I think with that, I'm kind of leave it off here, guys. Thanks again for watching my videos. I was quoted in a Business Insider article all about hedgehog risk management. I did go and place the link on my blog. Do check out that article if you've ever been interested in any of the hedgehog risk management services, or if you're just kind of interested in what hedgehog is. My whole inflation thing I did kind of take from Keith McAuliffe, because I do see it playing out. He may seem like a big douchebag on Twitter, pardon my language, but, you kind of have to be to try and draw attention to yourself. He's no better than Jim Cramer with the whole real-time alerts thing. But other than that, if you have any questions about the service that I have the morning newsletter, which is a little different than real-time alerts. You can shoot any questions that you have towards me. Please follow all the people in the Leaders Investment Club. In fact, if you use TweetDeck, there's a Leaders Investment Club list that's out there that has a lot of us on there that you can go and follow, so you can go and see all of our streams all in one awesome place. And I guess I'll have to see you guys next time.